Good evening, everyone. We've all made it to the end of April. Congratulations. I know it's been a tough time for everyone, but I'm excited to host this evening's webinar on COVID-19's impact on capital markets and dental valuations in Canada. In line with Dentalcorp's philosophy that knowledge is power, tonight's program will deepen your understanding of valuations, mergers and acquisitions, access to capital, and general financings. You will leave this call and webinar with a real appreciation of just how much has changed in the past 6 weeks and how it has influenced the future of the dental profession. Most importantly, you'll learn how you can thrive in the new normal whenever it comes and whatever it is. Let me begin this evening by saying that there's bad news and there's good news. Let's start with the bad news because it actually leads to the good news. The valuations of all businesses have been impaired by COVID-19. There are multiple reasons for this. Access to capital is restricted and the cost of capital has risen. There has been a drop in earnings because of the collapse of consumer demand and the shutting down of many industries, including our own. Patient psyches have also been hurt. Massive job losses and severe uncertainty make people afraid to spend. In many instances, their healthcare insurance has also been impacted. Operating costs will increase because of the infection controls and sterilization procedures that will be required to deliver care. The future will be a very different place to the past. And while no one can provide clear guidance over the next few months, we believe the overall dental industry will decline by double digits, and that is what we are managing for. The recovery, when it comes, will be slow and gradual. The great reopening is going to pose significant challenges on all fronts. Fortunately, we have the balance sheet to support our partners in weathering the storm. Okay, so that's the bad news. Actually, it's not the bad news, it's just the way things are. But here is the good news. If you were strong before COVID, you will become even stronger post-COVID. Even if you felt vulnerable coming into this pandemic, you can emerge better prepared than ever before to succeed. The next 3 months will be critical. So far, Canada appears to have largely dodged the bullet in a significant way. Infection rates and fatality rates are low. At Dentalcorp, we believe there will be a gradual resumption of services over the next quarter. And assuming there isn't a second COVID wave in the fall, which would be devastating, we're optimistic about enjoying a stronger Q4, but the recovery to last year's levels could very well last into 2022 and possibly beyond. Again, we are prepared for this. Whether you know it or not, almost everyone on this call is an entrepreneur. We have over 1,500 participants, most of who registered as practice owners. What an amazing turnout, and welcome again. As I was saying, an entrepreneur is defined as someone who makes money by starting their own business, which involves seeing a new opportunity and taking risks. The one thing that none of us could have ever seen was the massive risk posed by a pandemic. And while we at Dentalcorp couldn't see the exact nature of the risk, we could see the need to prepare for emergencies like it. It's in our DNA, and that's why we seized the opportunity to capture low-cost funding in February to the tune of over $350 million. And then, within a week of the lockdown, we prepared a playbook to manage our business to the new realities. Dentalcorp's agility and speed enables us to change real time as things change. And I share our actions with you because we will all have to demonstrate that level of creativity and flexibility if we want to thrive in a new reality. Our contributors tonight will be addressing the specific things that we all need to know and do as entrepreneurs and business owners when it comes to valuations and financing in a post-COVID reality. And so with that, I would like to introduce our three panelists. First off, Paul Gorman is a PhD and a Managing Director of Investment Banking at CIBC Capital Markets. Paul has over 15 years of capital markets experience and has advised on and led a myriad of mergers and acquisitions transactions and financings in a multitude of industries, including healthcare. Paul received his Bachelor of Biochemistry degree from Queen's University, his MSc and PhD in Medical Biophysics from the University of Toronto, and is a CFA charter holder. Welcome, Paul, or as you always ask me to call you, Dr. Gorman. I'd like to also welcome Cal Carpenter, who many of you know, and who is a Vice President of Professional Services at MNP. Working closely with medical and dental professionals, Cal provides valuable advice to help clients reach their business and personal goals. Cal's experience in forecasting, tax planning, and other key areas helps ensure his clients have a sound strategy for the future. He specializes in developing customized plans for clients interested in purchasing or starting their own practice or business. Cal is a CPA and completed a Bachelor of Management degree from the University of Lethbridge. And finally, another one of our very close friends and colleagues, Adam Levine, not the Adam Levine, the Adam Levine. Adam is a partner at MLT Aikens and a member of the MLT Aikens Executive Board. He's also the practice group coordinator for the Winnipeg Group. Adam practices in the area of taxation, mergers and acquisitions, and trust and estate planning. And he places particular emphasis on private corporation planning and reorganizations for professionals. Adam is a sought-after advisor to private groups on both corporate governance, tax planning, and business succession. Gentlemen, we are all privileged to have you here and look forward very much to this evening's dialogue. Thank you for coming. Paul, I'm going to start off with you today, and I will be focusing our conversation on how valuations are being impacted for all businesses, what deals are getting done today and in this environment, and how lenders are adjusting their approach given the significant uncertainty both today and in the foreseeable future. So first off, how are valuations being impacted in today's environment, and what does your crystal ball tell you about the next 2 to 3 years for all businesses, including dental practices? And as part of that, how are you seeing people establishing baselines for cash flows, EBITDA? Because today, more than ever in the past, it really is not a predictor of the future.
Great. Well, thanks for having me, and very good questions. As you mentioned at the outset, I think virtually all sectors have been impacted materially here. We've recently witnessed one of the fastest sell-offs in history, and we've seen coordinated actions from central banks and government stimulus programs that have provided some recent support, but there's still many questions around what a post-COVID-19 world will look like, and that continues to weigh on valuations and expected to do so for the next few years. I think when you think about dental practices and similarly physio, optometry clinics, you name it, across North America, these had previously been thought to be considered non-seasonal, non-cyclical, high recurring revenue businesses, recession resistant. I don't know if anybody really predicted that they could be impacted as well. But one thing the pandemic has taught us and proven is that industries that were previously thought to be undisruptible are not immune either. So with that, I think valuations have moderated and they will be reset over the coming years, given the difficulty in predicting future cash flows with so many unknown variables as when will the economy reopen, how will the staged reopening work, will consumer or patient behavior change, as you mentioned, will it be a permanent change? nobody knows exactly how this is going to unfold, which leads to uncertainties, which makes people take a different view of the risk profile. We've seen companies, even companies like CN Rail, that have significant insight into the economy, given the lead time they have with their shipping contracts. They've pulled their guidance, and they've admitted themselves that they don't have great visibility into how deep the impacts will be and how long it's going to take to recover here. So with all of this uncertainty, it's bound to impact valuations because they're driven by two factors, really: cash flow forecast and discount rates, which often get wrapped up in the form of a cash flow or EBITDA multiple. But with this uncertainty, and certainly with the people I'm talking to, they're using more caution in these cash flow forecasts and using a more conservative discount rate to reflect that uncertainty, which everything translates into lower multiples.
All righty. Thank you for that, Paul. I'm just going to follow up on that first question of mine and talk about how is M&A, apologies, being impacted? What do you see the majority of buyers doing regarding previously agreed deals and how they're approaching deals going forward?
Again, another good question. Certainly M&A activity has slowed considerably here, in large part to the uncertainties just mentioned, but there's other factors as well, including access to capital and concerns even around things like supply chain disruption and uncertainties around the business models. I think with the uncertainty around the near and medium-term financial outlook and the rate of an economic recovery, it certainly made it challenging to negotiate and structure deals. When you think about companies that have entered into deals prior to this downturn, in large M&A, there's typically a lag between signing and close. And these deals typically have a MAC clause embedded in them, which is a material adverse change clause. Essentially, it basically allows a buyer to walk from a deal in the event that something has happened, there's a significantly impacted the business or financial health or outlook of the target. And we've seen a number of buyers try to invoke this clause over the past few months. Ontario Teachers did it with their proposed acquisition of Abano Healthcare, which is the New Zealand-based dental operator. They signed a deal at the end of last year, and similar to here, there was a temporary shutdown of dental clinics in late March, and teachers invoked their right to walk from the deal under this clause. Another one that just happened is Sycamore Partners, who had an agreement to acquire a parent company of Victoria's Secrets. And interestingly, in that agreement, there actually was a carve-out for pandemic, meaning at first blush and upon first read that Sycamore was legally obligated to close on that deal despite the pandemic. But Sycamore Partners went back, tried to recut the deal, reprice the deal because of what's happened with COVID-19. The other side has refused, and now it looks like there will be a long legal battle to determine the enforceability of that MAC clause. So I think all of that said, there's going to be significant learnings from the current situation, and companies, management teams, boards, they're going to be hesitant to risk balance sheet flexibility here, certainly in the short term, and there will be more caution and a more cautious look at the financial outlook for target companies, both in the medium and probably the long term.
Great, appreciate that. Certainly provides tremendously good perspective for both buyers and sellers on this call. Before March 17th, lending was somewhat free and easy. Capital markets were wide open. Institutions from our Canadian banks and beyond were ready, willing, and able to lend money to pretty much anyone. And so how are businesses with high levels of debt being impacted right now? And what are the banks doing? Are they working with them to navigate the current environments? Like, how's it looking for them, just in terms of what's happened?
Yeah. So, as you mentioned, banks have certainly been very helpful in growing companies in the past. I think, we've continued to be supportive of clients throughout this pandemic. The banks have been working with their existing clients. And initially we saw two waves, I would say, as soon as we had the shutdown. The first wave was companies coming to us looking at their liquidity constraints and concerns about a prolonged shutdown. We worked through that with companies. Obviously, companies with higher levels of debt, that is even more of a concern. And then the second was around covenants, and which are largely and typically driven off of some sort of form of financial metric, which have in this unprecedented impact we're seeing in the short term. So we've largely worked through a lot of those things, and I think the banks will continue to work constructively, but I think there will be increased scrutiny put on companies with high levels of debt, and the comfort and level of willingness to use leverage to fuel M&A and support equity returns is going to be challenged for the next few years for sure.
It sounds like you certainly rather be sitting on cash today than on debt, or certainly a combination of both.
Absolutely. I think, the number of discussions we had with clients right as soon as the shutdown happened, first thing they did was look at the cash balance and try to figure out, model out if there's a prolonged downturn, how much cash do they have to support through that downturn. So sitting on a large cash balance is an ideal position to be in today's world.
Well, certainly makes me feel better. So just before I move on to Cal, what's going to happen after COVID-19? Obviously, lending, as I said, was free and easy before March 13th. Is that going to continue? And when the new reality sets in, are banks going to keep lending and providing capital for growth, acquisitions, and general business needs? What's going to be the play there? And what type of clients are they going to be looking for to continue to deploy capital against, even though somebody may be an existing client?
Yeah, so after this is over, whatever that means, I think banks will continue to be supportive. We do have government programs in place to help bridge companies to a post-COVID-19 world. That being said, I do feel there will be increased scrutiny on new loans. And despite the drop in underlying risk-free rates that we've seen, spreads have widened, which increases funding costs. And ultimately, that translates into higher interest expense on loans, or interest rates on loans. When our commercial lending group, they typically evaluate businesses in the context of quality and sustainability of earnings, which ultimately drives valuation multiples in enterprise. They'll do that work. They'll typically then look at a leverage, usually as a multiple of EBITDA, and effectively tie that to a margin of EV, enterprise value, which isn't dissimilar to how lenders look at mortgage rates or mortgages and car loans. But with this uncertainty of future cash flows and the difficulty to predict what this is going to look like, particularly in the near term, it's going to be difficult to have that comfort of the quality and sustainability of those earnings, which it has to flow through to lower valuations and smaller loans that were previously accessible. I think the bottom line is this is not going to be easier in a post-COVID world. There will be more rigor in the evaluation process for new loans. But banks, as you mentioned, they'll look for good clients. The preferred type of client, I think, are ones that will pose less risk. So those are ones that have well-respected and experienced management team. I think track record of operations and operational excellence is going to be critical here. They'll be looking for sophisticated management teams that have thought through all of the COVID-19 situation and potential outcomes. I can tell you from personal experience, I do find a great deal of comfort when you deal with a management team, not just in COVID, but in any situation where you have questions about potential risks that come up. And not only do they have a clear answer for that, but they can also tell you about other risks that they've thought of that you haven't, and they have answers for it. So you do need management teams that are sophisticated and have thought through all of the issues. And then lastly, I think larger scale helps and diversification. So larger and more diversified companies would be the preferred client for banks.
Great, really appreciate that. Love chatting with you always. You're a great friend, both personally and professionally, and really appreciate you taking the time. Stick around. Cal, I'm going to jump over to you now, following up on my chat with Paul. How are you seeing acquisition activity being impacted in the dental market specifically? I know you have a ton of clients and a massive practice in that arena. And what is the impact on business going to be in the new world order of enhanced PPE, IPAC standards? And finally, how are your clients faring? And so I'll kick that off with, given the current environment, How will the future of dentistry standards affect the business and earnings of practices across the board?
That's a very good question. Certainly at this point in time, there is an awful lot of uncertainty as to exactly what the opening up of the economy is going to be, the opening up of the dental industry again. And that uncertainty is going to have an impact. Now, when I take a look, and I've done some reading in terms of the Saskatchewan protocol, in terms of opening up their dental industry, and it's my understanding Manitoba is not too far behind. But certainly, we are anticipating additional costs going forward in operating dental practices, both in terms of additional PPE. Certainly, we are anticipating a slowdown in dental activity at the patient level, both in terms of the number of patients that practices will be able to see due to new protocols. There will also be some hesitation by consumers, I think, and to going into offices, going into businesses as well. Obviously, through the reading I've done on the Saskatchewan protocol too, there's demands to be made in terms of renovations, changes to operatories, sterilization protocol, all of which really we're sort of see a double whammy here in terms of less in the way of patient visits, and ultimately that, of course, lends itself to less in the way of revenues, and then an increase to some extent of costs. So I would anticipate going forward, at least in the short term, and when I say short term, I would say that's probably anywhere from 6 to 18 months. I would anticipate a drop in earnings for most of our clients and most dentists across Canada. So that's not to say that. Oh, sorry, go ahead, Graham. Sorry.
No, carry on. I thought you were done.
Yeah. Like in terms, you had asked about how clients are coping across the country. So in terms of our clients, certainly everyone would generally say they want to get back to work. I think that there's a uniform agreement in terms of that. People do want to get back to work. I think once again, the last 40 days or so have not necessarily been easy for dentists across the country. Dentistry is one of the few industries that have effectively been closed down. So there is generally no revenue or very little revenue coming into dental practices, which causes stress, obviously. Dentistry has an awful lot in the way of fixed costs. And so in terms of our clients and the dentists that I speak to, they are worried, obviously, about some of their financial positions at this point in time. The longer this goes on, of course, the more stress that's put under. How are clients coping with that? Certainly, lots are having discussions with their bankers in terms of stretching out the amortization on existing loans. Certainly, they're reaching out to their lenders as well in terms of increasing their operating lines of credit, reaching out to vendors, and by the same token, effectively managing cash as much as possible. So the government programs that certainly have been introduced over the last month and a half in terms of both the wage subsidy programs, what we call the CEBA program for $40,000 worth of financing. Almost all dentists, in fact, I was on a call yesterday, dentists are the #1 industry across Canada that have taken advantage of the $40,000 loan application. So clients are trying to make attempts to, once again, minimize cash and get through effectively the period of time over the next few months where it's going to be slower. But there's a lot of unknowns, and I think there's a lot of anxiety too, for that matter. In terms of your question,
there certainly is.
Yeah, no.
Yeah.
Oh, go ahead. Sorry, I keep.
So there certainly is a lot of stress. People are being forced to try and defer their obligations and kick them down the road, and so I think we're going to see a piling up of obligations, and whilst it relieves cash cash burn and cash obligations today, it's a lot of pressure on the future. And so the all-important question, which weaves into this narrative, is the question of what are you seeing on valuations at the moment, and what's your view on how they're going to be impacted going forward?
I think right now what we're seeing in the marketplace is really that there is not a lot of transactions going on. So, in terms of most transactions involving dentist to dentist sales, obviously are financed by the large chartered banks in Canada. And most of them are taking a look-see. Certainly, they're bending over backwards right now. I think the banks are doing a fantastic job of reaching out to their existing clientele, stretching out amortizations, working in terms of, once again, further revolving lines of credit and that sort of thing. But there really, at this point in time, is not a lot of appetite for transactions in terms of financing those transactions. There is too much uncertainty in that, of course, what was let's say, March the 15th, that world is different today. We don't know necessarily what that's going to look like. We don't know what patient levels are going to be like. We don't know exactly what all the protocols across the provinces are going to be. And we generally don't know when dentistry is going to open up. So I think banks are taking a look-see approach, which I think all of us as business people would say makes sense. And so I think most of the attitude is let's wait and see, let's get past into the fall, and then we'll get a better handle on how this is all sort of coming about. So at this point in time, it's quite slow from that perspective, and that's likely going to continue, I would expect, for the next few months. In terms of value,
I agree with you. I mean, sorry to jump in. I agree with you. It doesn't really matter what's written on a piece of paper in terms of value from usually an intermediary anymore, like it used to be. If there's a willing buyer, willing seller, that's your transaction price. I don't think the banks are going to lend or valuations and the like anymore. I think they're going to, as you say, take a look-see, take a much harder look. And we're certainly seeing people being asked to come up with, and will be asked in these environments to come up with equity if they're going to buy anything. And so the old world adage of loan to own, which has been in place for the last 5-6 years in dental, or even longer, has just been thrown out the window, and it's back to basics of two willing parties come to the table to get a transaction done, and the buyer putting their money where their mouths are and taking some significant risk on the way through, which we're obviously prepared for. And so when we talk about that, in terms of deals that are getting done, what revised structures are you seeing that are being put in place to account for the risks associated with COVID and the uncertainty around the industry that we all believe will prevail for the next 12 to 18 months and possibly beyond?
I see an awful lot of transactions that obviously perhaps people had discussions mid-March. And I would suggest that those valuations would be somewhat different today. I think what you're going to find is that a lot of transactions will be held over. Once again, it'll be a look-see until things get up and running. I think what we're going to see is off the cuff, lower valuations, because it only makes sense. Like in any business, when I work with our chartered business valuators in our firm that value any company, it essentially is based on cash flows, EBITDA. So if you've got less EBITDA, which is basically sort of what we anticipate due to levels of revenue that probably will not be quite the same for a period of time, and expenses that, if anything, will increase in value. So if you've got less profitability, I think what you're going to find is you're going to have less in the way of valuation. In terms of going forward, I think we might see things that we haven't seen for a long time. We have been very used to, I've been in this dental business a long time. And of course, we've had 100% financing for deals for as long as I can remember. I think we're going to see a lot more of vendor takebacks, potentially, that the seller may have to actually finance a portion of the deal. Buyers actually having to put some money down to do transactions, which is something I've never seen. And by the same token, we may have transactions where we may have what's called an earnout. We'll, depending on what the profitability is, you'll get some of your compensation at a later date based on that. So those are things we have not seen for an awful long time. So I think in terms of people who are looking potentially to sell, you know, you may, I'm not saying you wouldn't necessarily sell at this point in time, but certainly it's different than pre-March 15th, I guess is what I'm saying. And time will tell as to, hopefully things do come back sooner rather than later, obviously in the whole Canadian economy for that matter, but for right now it is not business as usual.
Thank you. I think I agree. And for you as well, really appreciate you being on the call. Since we started our business, you've been an invaluable resource to bounce ideas off, been a great drinking partner at times. So that I really appreciate.
Thank you.
But it's awesome working with you, and thank you for taking the time. Adam, it's your turn. I'd like to discuss with you your recommendations on, if you put your vendor hat on, what vendors should be doing in broad terms to protect themselves in a purchase and sale transaction, especially in this environment, and going forward, including against purchasers defaulting on their agreements to close and so on. You know, as we've continued to reinforce, the last 7 to 8 years have been pretty straightforward: fast closings, fast money. You know what they say about rising tides, and I'm sure you definitely know what they say about waning tides. And so, are you seeing changes, given that practices are either closed or partially operating, that should be accounted for in the LOIs, in offers, and in transactions more generally?
Sure. Thanks, Graham, and thanks for having me. You know, the last 6 weeks have been relatively remarkable. You know, I think on March 15th, we had, 25 mid-market deals, which we're working on in all different industries, and they almost all paused within 1 week, including those that were in the dental world. And it turned deals on their head because, as you said, there was typically a very short time period between LOI, negotiation, signing, and closing, which eliminated a lot of the need for consideration of protection of vendors and purchasers as appropriate in terms of longer term deals. And there was also a great faith on behalf of vendors often that the deal would be available perhaps long term, so there wasn't a need to rush things through. So fast forward, we've had this sort of never happened event happen to all of us, and in industries like dental where you are totally closed and it's not certain when you're going to reopen. So what do you do as a vendor? Well, you look at ways you can put your deal back together, and you can try and preserve your value. So things like deposits, which weren't typically part of sign and close transactions in mid-market deals. So you signed your agreement on the day you closed. We're now recommending something like that, which are not refundable to the purchaser, assuming the vendor can meet certain requirements. We're taking very close looks at the promises that vendors are making when they're making to purchasers about their business, because reliance on financial statements, for example, or financial history is probably out the window now, because the next several months are going to look fairly different, everybody expects, from maybe the last number of years. And so when you make promises in a purchase agreement as a vendor, you don't want the purchaser to be able to come back after the deal closes and say you told us something that was incorrect. So we've had to reimagine what type of promises a vendor is making to make sure that they can actually honor that. And we've also had to consider what's reasonable to offer up. What can a vendor undertake to a purchaser to keep their deal intact? So Cal mentioned earnouts and VTBs, and those are all sorts of things that may allow for valuations to get closer to where they were pre-COVID, but require some risk allocation that's different. Pre-COVID, the purchaser took all the risk on the financial stability of the business and the cost going forward. Post-COVID, we're definitely seeing, when acting for either purchaser or vendors, that risk allocation is shifting.
Appreciate that. And so following on a little bit on that and just peeling the onion a bit, I want to chat a bit about how standard purchase agreements in your mind and from what you're seeing have been affected. There's things like interim period, reps and warranties, deposits, deal structures, diligence and closing, a whole bunch of things that go into a standard purchase agreement, which don't really vary much in their themes and intentions. But in this era and in the future, for which we all see a lot of uncertainty, what are you seeing in terms of the effect on those agreements?
Yeah, that's a great question, Graham. And Paul touched on the material adverse event clauses that appear in many agreements, and typical other delivery that you would find in a typical dental deal, for example, something called a bring down certificate. So that confirms the promises that you've made in the agreement are accurate as when you close. So we had many deals, some of which were signed, like Paul had indicated, which the vendor couldn't deliver that bring down certificate because the promises weren't accurate. So we're now in this middle period where, in the case of dental, the businesses are in fact closed, so they can't deliver on those promises. So we've had to reflect on what's reasonable to offer as promises after that interim period, what a reasonable interim period looks like, when there's a trigger to force the purchaser to close. In other words, when, in the case of dental, the regulator says, okay, you can open again for business in a similar fashion to where you operated pre-COVID. Who bears the costs of that reopening, what security there is for the vendor to force the purchaser to close, what's the purchaser's capacity to close. So that's all gone into consideration, which weren't really much of a discussion point given the short time period between negotiation and closing before.
Oops, forgot to unmute myself. Sorry about that. So given the uncertainties in the market, and again, going back to just 6 weeks ago when, buyers put their hands up and said, I was going to buy you, it was almost a fait accompli that the transaction was going to happen. Given that the environment's so much more skittish and purchasers are looking for options to buy practices or businesses in general, may not necessarily have the financings or other wherewithal to close. What are you recommending your clients who are vendors look to do to protect themselves from a purchaser's inability to close?
So, nothing has really changed on that other than we're now acutely focusing on it, which is capacity. So the question that's always asked at the beginning of any purchase, and probably Cal and Paul are asking the same questions, is what is the purchaser's actual ability to close? So, it's one thing to put a number on a letter of intent or an agreement, but can they deliver the purchase price on that date? So we're asking more questions now. We're asking about with vendors. Do you in fact have financing in place? Do you have a credit facility that allows you to close? Can you provide evidence of that? Is there earnest money or deposit money, either refundable or non-refundable, that can be put up that we can rely on in the event you can't close? What is your track record? What is your organizational strength? One of the big concerns for vendors in any industry when they sell, whether they're continuing on or not, is they generally want their employees and their business to be looked after well. So in the case of dentists, you want your patients and your staff to be taken care of well. So what is the ability of the purchaser to execute properly after closing? Do they have the resources still? Do they have the staffing, the resources, and really, as I said, most importantly, the ongoing financial ability to operate? And of course, that's the biggest test that's on right now because everybody is closed. And when you look at dentists, and I've been said to a number of my clients who are dentists that, imagine your pain in one practice, and then if you're dealing with a purchaser that owns multiple practices, multiply that out significantly, plus they have paid for those practices where you've often grown them yourself.
Thanks, I appreciate that. I'm sure anyone who is a possible seller of a practice in the future appreciates everything you've counseled us on this evening. I must say, you two are a great friend of all of ours at Dental Corp, and I have such a tremendous amount of respect for you as an advisor. Most of the time we spend is acting opposite each other on transactions. You have represented a lot of the folks that we have partnered with, and you've proven to be an incredibly versatile negotiator and adversary at times. And so I want to thank you for that, because it actually makes us better. And if anyone's looking for a great lawyer, I'm plugging Adam Levine. We've had, as I said, over 1,500 registrants that are on the call today. We had a ton of questions come in. And what I'd like to do is throw two of the questions out. We literally threw them into a hat and came up with these two. First one is, and it's a free-for-all, guys, in terms of who wants to answer. But the first one was, I'm a young practice owner, and if younger dentists, in particular new grads and folks that are a few years out, will have a harder time securing financing, I would assume that I will have a greater opportunity to get more associates, hire these folks, and further increase my revenue and cash flow, leading to a greater future valuation. Am I something? Guys, anyone?
Oh, okay, I'll give it a go. Or, it's interesting, Graham. I've spoken to a number of bankers that typically bank dentists in building out practices. And similar to what you said earlier about purchases, it used to be that lending to dentists was a very, very easy process. I had a conversation yesterday with someone who deals quite prominently with professionals. It's her whole portfolio, and her whole world has been turned on its head. So the path for younger dentists is very difficult now. It was difficult perhaps before because of consolidation in the industry, but there were still lots of dentists that went out on their own and built out their own practices. But the cost of building out a practice was significant before. Cal touched on the additional cost that you're likely looking at, and then Paul talked about, of course, the cost of credit and the availability of credit. So, it's going to be much tougher unless you have equity of your own that you can put in to start out on your own. So then you've got to look at other options, and that is, associating or trying to develop something outside of owning your practice. So, it's a much different world than that existed 6 or 7 weeks ago.
Appreciate that. Anyone else want to add to that?
I'll speak briefly about that. I think that's probably a fallacy to some extent to expect that, that people will have very few options. So you as a practitioner will be able to have access to all those people. I think realistically, dentists will continue to do deals. Transactions will occur. Those other associates that you're looking to hire, they will make deals with dentist to dentists. Perhaps those selling dentists won't get quite exactly what they might think they would have got before. They may have to act as the bank and vendor takebacks. But I don't see that. I don't see that you could rely on that you're going to have this stable of readily available associates. I would say in your business, Graham, that's always a difficult, attracting good people is always the most difficult thing. And so I don't think that's going to all of a sudden become a heck of a lot easier. So people who want to be owners will become owners. It may be different through different paths, but there still will be owners and there will be associates, and that will continue on. So I'm not sure if that answers much, but that's sort of my thoughts.
No, I think that's fantastic. I think you both summed it up perfectly. Moving on to the next question. being 7 to 10 years out from retirement, what risks do I face if I hold on to my practice for a couple more years to rebuild from what we're going through and what we've gone through in this environment?
I'll take a stab at that one too. You know, a lot of the issues that existed before March 15th still exist today in dentistry. So, you know, certainly what we've seen in Canada over the last, 5 years in particular is an increasing number of dentists, increasing competition. Certainly in urban centers, large urban centers, we would say that perhaps there are too many dentists on the street. I think for a lot of people, it makes sense to think about what will occur down the road. There's no guarantees, of course. You know, if people would have looked at the last 5 to 8 years, they would have said, well, geez, I've done very well in terms of my value of my practice. Prices have never been higher. So why wouldn't I just continue to hold on to my practice and everything else like that? I think there's enough uncertainty that you're going to get back to a situation to some extent where people will want some certainty in their lives, that they will want to know that 5 years out, 3 years out, that they actually do have a buyer, that there actually is a way for them to ultimately retire, move on, do whatever they want to do. So I think there'll be more emphasis on people sort of planning out their career, their retirement. And so I would still advise clients, to be honest, to still consider, that maybe right now is not necessarily a bad time, maybe not today, but you certainly should still be considering what you want to do in the time frame available. And there are ways, as we talked about, maybe the value is not today what it was a month ago, but through some of the things we talked about, whether they're vendor takebacks or whether they're earnouts, I think we can have satisfied parties at the end of the day. But you still have to think about what you want to do and when you're going to exit on your own terms. So,
appreciate that, Paul. You were going to jump in on this one.
Yeah, I was going to say, similar to what Cal said. I think there's certainly a lot of uncertainty today, and nobody anticipated this pandemic would have led to a shutdown of dental clinics in the first place. So waiting it out, I agree with Cal that maybe not at this exact moment, but as you start to get some sense of an understanding of what it's going to look like, and you can get an agreement on both sides, and both sides actually have comfort, and it's beneficial for both sides. It does make sense to consider that in the near term rather than waiting out for 7 years if you're that close to retirement and you have the ability to do it now. The other thing you want to think about is your longevity in the space, and depending on who you're selling to, whether or not you want to continue on for a number of years, you want to factor that into your thinking as well.
Yeah, I agree with you guys. From my perspective, anytime I've really gotten punished in my business career has been trying to pick the top or trying to pick the bottom. And if it's the right time to do something, then it's the right time to do something. And you can't hang on to what things looked like a month ago, and you can't hold off for what you believe things might look like in the future. And based on a lot of the things we discussed today, there's certainly a way to structure a relationship and a partnership, which is what we do at Dentalcorp, that focuses on the long term, and that doesn't punish people for doing something in a softer market, and rather rewards them on the merits of their business and their business performance going forward. So appreciate your invaluable remarks, all of you on this call today. You've all really added some tremendous value, I believe, to everyone on the call, and in terms of their tactics and how they're going to navigate these really troubled waters over the next 3+ months and beyond. But before I wrap up, I'd like to ask each of you, to put yourselves in the shoes of a seller in today's market, or any market for that matter, and talk about, in a perfect world, what you would each be looking for in a buyer.
I'll take that first question, this question. In terms of whenever we're looking at any transaction, whether it's in the dental space or in any other industry, obviously the seller wants to complete the transaction and ultimately wants to be paid. They want to exit. If they're going to exit the business, they want to exit and know that they don't have any risks or assumptions of things that are occurring when they're not active in the business. So I think things that I would always look for, whether you're selling to any group or whether you're selling to an individual dentist, including in the future, of course, is do we have the ability to realize the proceeds that we're selling for? If you're selling to an individual dentist and let's say you have to come up with X amount of money and you don't have that, and you have to act as the banker, so as the seller, I got to act as the banker. Guess what? I'm retired. I'm living in Florida, Arizona, whatever. I don't want to come back and practice dentistry. I want to get my money and get the heck on and move on with my life. By the same token, if I'm staying on and working as an associate, I think I want to have, I know I want to have a group that's got the financial wherewithal and the management that continues on the business that I built. So I think those are the key things for me, is I want to be able, studies would tell us 2/3 of dentists need the sale of their practice to retire comfortably. So this is a huge transaction. So we want to get it done. We want to get paid for it. And we don't want any headaches staying on as an associate or just walking away. So those are my thoughts.
Great. Appreciate that, Cal. Anyone else want to give it a go?
Sure. So I touched on it a bit before, and I think, I'll touch on dentistry in particular because, I've probably had a conversation with 40 dentists in the last 2 or 3 weeks on what they should do going forward and what that fit is. And, it's a unique industry, no different than chiro or physio that someone touched on earlier, because you are in a sense selling yourself, and the value of your practice often relates, depending on how you're structured, to your ability to work. And if you're not working, it may depress the value of your practice. So applies to two things: timing of sale, because in the dental world in the last 10 years, often the highest values have been paid when the dentist agreed to stay for a period of time after you close. So waiting too long is dangerous if you want to drive valuation, and that may be the case going forward. But also, you never know when you personally are going to be disabled or unable to work. We have a pandemic now where nobody can work, but the reality is life will eventually go on, and people will have other health issues that will affect the value of their practice. So waiting is a danger game. In the last 20 years, we've seen a huge increase in valuations, which has caused many people to wait. You've heard tonight that valuations may go down. Whether that is true 3 or 4 years ago, nobody really knows, but there's other factors that come into play in deals where you're trying to get top dollar in the market as it exists today. So having said that, most dental deals do have dentists that either are required to stay or often want to stay as an associate in their practice on some basis. So being really comfortable who you're partnering with. Is it a good fit on a personal relationship basis? Get references from other dentists if this is a purchaser that has bought many practices. What is their back office support? What are their resources? What's their financial capacity? So not only can they cut you that check when they close, you've heard tonight from all 4 of us that it's likely that some of the consideration is going to be contingent on some deals or paid later. So are they going to be able to pay that to you 2 or 3 years down the road? And can you work with them? Or are they going to make sure they pay your staff and treat your staff well and pay your other suppliers?
Great. Paul?
I wouldn't have much to add. I largely echo the comments of Cal and Adam. We always stress, whether it's a small or a large M&A, speed and certainty with the buyer is essential. As Adam mentioned earlier in his comments, we're looking for people who can move quickly and expeditiously and have the resources to close a deal. There's going to be increased scrutiny on that concept, the resources and the ability to close a deal. You know, it's not just going to be taken for granted. It's going to be it's going to require proof, and there's going to be a lot of scrutiny on that aspect. And then lastly, certainly any deal where you're partnering with an individual or a corporation, you want to make sure that they have the financial wherewithal to manage this downturn if it's a sale in the near term. And you want to make sure that you're partnering with somebody who you can trust, somebody who who you feel through the discussions and throughout the transaction discussions that you feel really understands your business, has an ability to add value to your business as a combined entity, and can create value throughout this next cycle, whatever that looks like.
Thanks, Paul. And thank you, gentlemen, all of you again, for everything that you have given this evening. Even I'm feeling more empowered after hearing all of that and all of your insights and perspectives. And I hope that everyone now understands the fundamental factors driving valuations, financings, and M&A, in particular in the dental market. I also hope that you have a clearer sense of how to maximize your returns while you de-risk your business in the months ahead. I know that this is a stressful time for many of you, but it can also be a fabulous time of growth and opportunity. Ignorance isn't bliss, it's detrimental. It's knowledge that's the key to success. And after tonight, you have some clear insights into what really matters, financially speaking, that is. And I'm sure you also all have many unanswered questions. So please reach out to us with them and we'll do our best to answer them. And so until next time, please remember, every problem has a solution. You just have to be creative enough to find it. I want to thank you all again for taking the time and have a great night.
Thank you.